Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, February 22nd, 2024. It is 1:08 p.m., so I'm starting the video, and here's what I'm going to cover in this one. We're going to look at, we're going to focus primarily on Treasury bonds, but more so for what it may mean to the market. Now, there's two takeaways here. You know, what I do on the site, the main services provide, I provide technical analysis and trade ideas. And this can be either or. I'll tell you how you can use this as a trade idea. Also how to, factor it into your analysis on the markets. And I'm going to get towards the tail end USO because they're all related, USO being crude oil. I just fired off a post to you on natural gas before this, so there's no reason to go over that because that was just pretty simple stuff. It's that sport, either take it or not. Comes after a divergent low and a breakout. But again, they do kind of relate. But let's talk about this. So this is IEF. Remember, IEF tracks the 10-year Treasury bond. It's the color-coded boxes I've given you lately, and we still remain solidly within that yellow zone. And we've certainly seen the stock market take note. In fact, QQQ, as strong as it's up today, is still down from where it was when it entered or shortly after it entered that yellow zone. So, but here's what I wanted to show you. Now, I've covered this in the past, but to me, it's a extremely compelling chart. And I'm going to kind of throw some, caveats that, there's about relationships. And this, in other words, is a positive correlation between bond prices and the stock market, which is also the same thing as an inverse correlation to yields in the stock market. Remember that bond prices and yields have an immutable on Treasury bonds, that is an immutable correlation between prices and yields. One goes up, the other goes down proportionally. And there's no variance in that. Corporate bonds, it's a little bit different because then you have credit quality that comes into play. And so you can have a change in yields and yet some change in credit quality for the better or worse can offset that. So that's why I say specifically Treasury bonds, because they're viewed as virtually risk-free. And so that takes that out. So then you only have the interest rate effect. Okay, that's just bonds 101. This is way back here is COVID. That's when the S&P fell in 6 weeks, dropped 36%, and COVID hit. And this was the extreme response to the pandemic where the government took rates down to near zero. That took bond prices to their, pretty much all-time highs, which at that point they had, they didn't take, remember, the Fed doesn't control or set the rate on the 10-year or the 30-year or even the 1-year Treasury. Those are set by market rates, but the Fed does control the federal funds rate, which is an overnight lending rate, and eventually that tends to trickle or impact the bonds. But just wanted to make that very clear too, that they don't set the 10-year, that's set by market forces, but they can certainly try to exert influence on it by quantitative easing, buying bonds and things like that, buying and selling. And so pretty much, if you all recall, this is just a quick recap. The market exploded after it due to both the fiscal and monetary stimulus. And at this point here, myself and an increasing amount of others were saying, look, inflation's a problem. We're seeing prices go up everywhere. And bonds are reflecting that. You've started seeing bond prices drop. That meant, because the white line, I'm sorry, guys, if I didn't mention it, and you can see it up here. IEF is the 10-year Treasury bond in white. QQQ is in purple. So rates started to rise, and the Fed was completely dismissive of it for a long time, too long by their own admission now, of course, saying it's transitory, and then boom, we saw the worst inflation in nearly 5 decades. So we all know what happened from there. So I'm going to zoom in to when rates started to matter to the market, and that was when when stocks peaked back in the late. Technically speaking, the NASDAQ 100 and the NASDAQ peaked in November, put in effectively a double top, slightly lower high, and that's when the S&P peaked right at the beginning of 2022. So, and you can see this is, again, bond prices were falling, meaning yields were rising. It didn't matter to the stock market until all of a sudden one day it just did, and then it did big. And then we had the biggest, correction, if you want to call it, bear market, if you want to call it, again, to me, semantics, 20%. Definition is long since antiquated as far as calling for a stock market bear or bull market, because we've seen in recent decades with excessive Fed intervention and very loose monetary policy, we've seen, a lot of volatility. So again, we can call it what you want there, but it was obviously over a year-long drop into, the NASDAQ again. The main focus for me in trading and all that, the stock, the S&P bottomed in October, but the NASDAQ really bottomed right in the beginning of January and then took off from there. And you can see what I'm showing you here, guys. We're looking at this correlation. And I talk about this a lot. When you look at correlations, when I'm overlaying two securities like I am here, the NASDAQ again in purple, or the NASDAQ 100, QQQ that is, and IEF, the 10-year Treasury bond, don't expect the lines to overlap because they're not priced in the same price increment. They don't go up and down the same percentage terms day to day. A high end on the range on QQQ is what we're seeing today, close to 3%. It's not a cap, but it's really about as big a day as you typically get. And the same thing on the downside. Again, you could put a bell curve and put it in there, and you're going to see 99% plus days falling within that range. And on treasuries, a big move is about 1% a day. So what you want to look for anytime you're doing a correlation or comparing two assets, two securities, that is, and looking for the correlation. You want to compare the when do they turn? When are they going up and down at the same time? And again, don't worry about a day-to-day correlation. We're talking, one day one might go up and the other down, vice versa, but it's not a big deal. You're looking at the overall trends, and especially the main primary turning points, the peaks. And so you can see, and nobody can argue, that the rates have been the market has been hyper-focused on interest rates, and there's been a few opportunities. See, there's some, it's one thing to show you two securities or two things, such as, let's say, bond prices and bond yields that have a perfect inverse correlation. There's no predictive value. One goes up, the other is going to go down. But where you can glean some maybe some predictive value is when you see divergences between the two. And as long as this environment remains, which I believe it will be, we saw that with a just ever so slightly hotter than expected CPI recently. Market had the biggest drop in months. It shows you that there's still some worries. And as I said back then, one day doesn't make a trend. But if you continue to have day after day or report after report, a trend starts to emerge, then that's going to really matter and not just a one-day move. Okay, so you can see the correlation. Let's not go over that. Look at where they major peaks and turns came, and you can also see quite often, like for example right here, if I take the line down, this is when bond yields were falling because bond prices were going up. They peaked right here, and then bond prices started going down, meaning interest rates are going up. And the market at that point, here I'll zoom in a little tighter for you, didn't get the message right away. The rally in stocks and QQQ continued while bond prices fell, but then they got the memo. Somebody slipped it in front of them to their desk, and they're like, oh, shoot. Rates are going up again. And they were, and then the stock market had, again, one of its biggest drops up to that point. And so, I implore you to go out on your own and look at these charts and zoom in different time frames, and you can see, again, virtual near perfect correlation. But this, and I pointed this out, this is the biggest, by far, without a close second, the biggest divergence we've had in some time, and that's why I put us in the yellow zone with IEF. Bond yields, even today, we're seeing one of the biggest, and again, to me, one day doesn't make a trend, but it's one of the biggest up days in the NASDAQ. And yet, Treasury bonds, as I speak, I'm looking at ZN, the 10-year Treasury bond futures on one of my other charts, down 0.21%. So we're still, I'll flip to that in a second, still in the yellow zone. Okay, what's the takeaway? Here's the scenarios. Number one, this doesn't matter anymore, and now the market, rising rates don't matter much, just as they didn't back, for decades now, at least over a period of, a couple months. I don't think that to be the case. So far, it hasn't proven to be the case. On the contrary, every time we've seen such divergences, the stock market quickly played a game of catch up. So, and I think that'll be the same thing here. Now, it's possible, certainly, when you get divergences, the mean reversion could come in the form of Treasury bonds rallying, and I can certainly make a case there. If, there's some nice positive divergences, as there have been for a while on the 10-year bond on the 60-minute charts, which is a good swing trading time frame. And if those do play out, then yeah, you could see bonds up. So takeaway number one, I told you, trade ideas out of this, is a paired trade. Now, we don't have, at this moment, I want to see, as I told you before, there's no reason it would be unobjective and wrong to short QQQ if it doesn't fall back or close today back on or below the primary uptrend line. So, but with that being said, if it does, then, and you get that sell signal, one thing to do if you decide then to short QQQ, let's say you had no positions. Let me speak to that person today, because there's been so many in and out kind of entries, exits lately. Okay, I had a brief interruption there. I think what I was saying here is the paired trade, where you would go, in this case, long treasuries and short QQQ for mean reversion. Again, that reversion can come in the with bonds up, with stocks down, or a combination thereof. But what is extremely, in my opinion, let me repeat that, extremely unlikely is to see bond yields continue to fall and stocks continue to go up. And if that is the case, the longer it happens, the more powerful the mean reversion will be. That is my strong opinion. All right, so just wanted to point that out. And again, we haven't seen anything like this divergence in a while. Today, to me, is, and I'm looking, I go through hundreds, if not thousands of stocks on a day like today. And what I'm seeing is a complete and utter, I'm going to call it a rational response. Now, the price action is first and foremost. I get that. But, NVIDIA, we know NVIDIA lives in its own completely unique bubble as the king of AI, the biggest by far, no close second beneficiary to AI. Google, Apple, everyone getting on board that AI train. They're having to order their chips from NVIDIA. Even read that, one of the analysts last night when I was waiting to see what the earnings came on, turned on Bubble TV, probably a good point. A lot of the gaming chips, chipsets they make, the GPUs have been retasked in China because China can't even get a hold of the servers for AI, those chips made for that. And so it's even helping them there. Screen kind of toggled over. So when you see a day like today, and one thing I'm going to get to in this video is the small caps. The small caps were flat to down in the morning, as they should be, because of this. Again, as I just said, the 10-year bond being down today, meaning yields up while it's still in the yellow zone. And of all things out there, the small caps are by far, and this is not subjective, my opinion, it's a known fact, they're much more sensitive to rate changes, rising rates, than large caps are. But you have two things going on. Number one, you have the snapback in SMCI, which naturally, because NVIDIA was up and they've been tracking together, and somebody pointed out in the site, and then I did read it, it's a ginormous weighting, the unnatural weighting. Usually the Russell's pretty well balanced among their components, because there's the Russell 2000 index doesn't have a full 2,000 companies, but I think last account, my watch list, I think it's like 1,600, close to, so 1,750. I think it's about 1,748 or something. But they're usually balanced, but there's a huge overweighting right now because they hadn't moved out SMCI yet. It's a big cap company in a small cap index. It just, they haven't done their biannual rebalancing. And so that was pulling up today, but then I saw IWM start to catch a bid beyond that. But I'm going to get to that in 1 second. And I'm seeing other semis that were down rally. They're not beneficiaries of the AI bubble as much as SMCI and NVIDIA, but yet they're rallying in sympathy. And again, it's a one-day thing. If yields were, and they still could turn, if yields start to fall pretty sharply, then yeah, it would support today's rally or support the case for a continuation of the uptrend. But again, I don't want to beat a dead horse. The longer this lasts, the less likely that is. And this is again stark divergence here between the two that I'm noting. There's the zone, there's the yellow zone. So you can see here we keep we're holding around the same level, and there's that divergence I talked about. You also have it positive divergence, that is. So there's certainly the potential. And look, if that happens, and again, that's where a paired trade would be. If you happen to be, no, you don't have to be short, but a paired trade, you'd want to be again long treasuries for that, and then short, especially rate sensitive things, in which right now are pretty much high flyers, small caps, and even big tech. Okay, before I get to the small caps, I think there's been enough said on that. Let's get to the indexes. Let's go to the small caps, and then I'll get to the QQQ. This is IWM. This is a 60-minute time frame. These are divergent highs recently right there. There's a sell signal, drop, a divergent low, you bounce, divergent high, little wedge, broke down from the wedge, hit. And we've been hitting this major primary uptrend line. I've been talking about these till I'm blue in the face, but they're, to me, very important. All the indexes have them, SPY, QQQ, and IWM. And so IWM has been dancing on it, still above it, and needs to take it out. But on the bigger picture too, and again, we had that most recent divergent high. And so this today is attributed, in my opinion, 110. I like to always say that 100 extra 10% for say attributed to NVIDIA earnings. NVIDIA has nothing to do with the small caps, but SMCI does, because it's in there, and SMCI has a lot to do with NVIDIA, and it has an overweighting. And then it's also animal spirits. The small caps are more aggressive, high flyers. They tend to go up with their risk on. When the market's strong, they tend to go up as much or more than the. But so that's what's given the bid, because fundamentally, with rates ticking down again today and staying at those multi-week highs or multi-month highs, that should be a net negative for the small caps, and I have little doubt that it would. Now, they're not up big, by the way. They were flat this morning. They're up, 2/3 of 1%. This is the bigger picture. You turn off all the lines, and you have this big, fat, multi-month trading range right there. Actually, multi-year. So it's going on 2 years now. We've been in that range, or a year and a half, I should say, about. And so there's the top of the range. And as I said recently, that's the previous reaction high is a pretty significant high. And if they can pop that and continue on, it's still going to have big divergence. You can see from my line here, this is the divergence we have. It's super steep and strong. And what that means is, there's the top of this, bottom of this trading range there. A breakout is not going to take out these divergences anytime soon, but it could bring some fresh buyers in. Now, if it were to break out, let me say this very simple. That's why we're talking bonds and stocks together. If the 10-year bond starts to rally, especially if it gets back out of the yellow zone into the green zone, yes, that's going to support the case that a breakout will, at least for some period of time, stick, and then you could see a pretty good move up. So there's a trade idea for you there. But if it goes the other way, yields keep going down, I'll get to the bottom of the yellow zone, especially enter my orange zone, and or, that's why I cover both these. You break this uptrend line, then that's bearish, and that's going to send small caps lower. So there's the small caps in a nutshell. All right, QQQ. Let me give you the clean board. Let's keep it very, very, very simple, as we're trying to do lately. Like I said, this has a potential. Should we get a dump into the close today? There's still an hour and a half for that to happen. So far, it has the makings of a trend day. A trend day is when a security opens up and continues up pretty much steadily all day and closes at the highs, but yet a lot can happen in an hour and a half in the stock market. I don't have to tell you that. So I'm not trying to make any predictions here, but more of reactions. Reaction would be if it closed back on the trend line, it's a successful back test, especially if we start moving back down below there. File after today, if we, so we basically, let's, draw it out, could play out. We'd have to, again, if we closed, and remember we have gap resistance there, or a little above it now. We need to close down on that on this daily chart, and then start to move down. Then all this is a breakdown, a back test, and a rejection. But if we continue up, then what this is right here, that is a false breakdown, aka whipsaw, aka bear trap, whatever you want to call it. So the day is young. I'm not calling anything until the day is over, and then we'll look at it then. And if I have to squint and say, is it on the trend line, not on it, I'm just going to call it a break even and say it's we parked on the trend line and to be determined. In other words, we'll have to see what happens tomorrow and or next week. So as far as inflation goes, you have to wait for the numbers. The numbers are questioned by many, especially the CPI, because they're subject to revision and the whole processing of it. There's a website out there I've heard of called Realflation. You can check that out. They claim to do a much better job using their own metrics and tracking inflation. But one of the biggest impacts to inflation as a whole, and one that we can actually track in real time, second by second, not even day by day, zero lag, is crude. So we're going to look at crude now. And again, remember the other day, just an ever so one tick, 0.1% higher, slightly hotter than the expectation CPI, but nothing red hot. And the market, really freaked out and yield spiked up. So this is one, if you want to kind of get an idea where inflation is going to go, and nothing matters more, especially nothing that we can track in real time, than crude oil. So crude's been in a little stealth rally here. And you can look at it on a 60-minute chart. Man, it's not random. We put in a divergent low back here. I pointed that out, positive divergence. It's been walking up this uptrend line. This is a 60-minute chart, and that was following the divergent high. So this is where, Powell didn't say it, but kind of said it. Everyone knows that, declared, what is it? Mission accomplished. But of course, wouldn't say those words. And Bush kind of ruined that years back with the whole Iraq thing. But here's USO. There's the uptrend line. And if you look here, we have, you can see what's happened now. Here's a low. This low. This low. Yep, you got it, guys. That's what I'm doing. I'm showing you a clear and unmistakable near-term uptrend. Could end any day now, but as of today, we've clearly now taken out that previous high. And look, here's a pretty significant, actually several. This is good resistance we're at right now, about $74 on USO. Why is it good? Well, that was a major reaction low, not just a little reaction low, but a major, after a big drop off the highs, big bounce, double-digit drop, double-digit rally off it. I think that's safe to say that's a key reaction low. Tested it for about a week there, broke it. And we didn't just meander on down. It was two big red drop candles, big impulsive selling, rallied back, bam, smacked down, rejected, tried again, smacked down even harder. So this is a significant resistance level. Do we break it? I don't know. Maybe. But again, what I'm telling you here, I'm providing analysis. If we do, and it's clear and we build on those gains, maybe not the first day, maybe, or maybe a few days later, the higher we go up, I promise you're going to start hearing about this on TV and start reading about it. And I promise you it's also going to have an impact on inflation, whether there's other things offsetting it, whether the market dismisses it because AI is all that matters now and interest rates don't and the like. But I'm telling you the things I'm watching. So that's it. In this video, it's pretty simple. Bonds, which I've been hyper-focused on lately. And again, they can go either way. But like I told you yesterday when I think in the video, I said, these boxes I have on IEF, it's not a prediction of where we're going, but it's more of a prediction of what's going to happen if we do get into these zones. And same thing on the upside. Bonds start to rally. Like I said this morning, it doesn't mean it's guaranteed to be bullish for the stock market, but that's just a net bullish impact on the market when rates, bonds are going up again, means rates are falling. So that's it. Watch this, and over the next week or so, again, the point I guess I'm trying to drive home is today's rally is not being supported by a fall in yields. In fact, they remain at or just made today. If you really want to split hairs and look, today we just made a new multi-month high. Let's do this. So today's low, if I grab here, go back, we haven't seen yields this high, or at least IEF this low since, I've got to go. Yeah, that undercut it. We have to go right here. I have to put a horizontal line. That goes back to my crosshairs. That was the beginning of December of last year. So last December. So we just made a new multi-month high in yields, and the stock market's partying like it's 1999. And maybe it knows what I don't know. I don't know anything really, on this as far as this goes. What I know is I can draw a little wedge. Maybe that breaks out, does it, or this falls apart. But what I can tell you, another sort of red flag I've seen. Here's a stock. If you've been with me for a while, we've had some nice profitable trades on this one, long and short. Slayed it, played it like a grand piano back here off these highs. Long, shorted it here, back down. And this is MKTX, Market Access Holdings. You look them up. If you want to look up any company and see what they do, one of my favorite sources, super easy, is type in the symbol MKTX and then space Yahoo. It'll bring you Yahoo Finance, and then click on description. It gives you the company description. And so this one, what they do is they operate an electronic trading platform for institutional investors and broker-dealer companies worldwide. I'm reading off that. So they have, they're into bonds, corporates, treasuries, and something's wrong here. Something's wrong with this, with this chart. It's just maybe it's a red flag. This company, like so many, remember, if you back out a handful of big tech companies, majority of companies are still well off their highs. This company peaked back in 2020. And more importantly, I know there's a lot of companies coming off the lows, but this one's flirting with a new bear market low. And why is it doing this? What is that telling us? Something going on in the bond market or about to happen in the bond market? I don't know. It's just one of something to keep an eye on. Yeah. Maybe a low-level bullish PPO crossover. Tried to do one right here, but it got rejected. So maybe it rallies. And even if it does rally, this is still much closer to a 52-week low than anywhere near a 52-week high. And I just wanted to point that out because, again, all I'm saying is do not underestimate the power of the Treasury bond market. Smart money watches it. And it matters. And the bond market really does matter, and rates do matter. And so, the stock market hasn't freaked out. We remain in the yellow zone, but again, like I said, you had to split hairs to look closely to see we're slightly lower than we were back here, but it's now we're trading essentially where we were, just a hair lower. What is that? 8 days ago. So that's why the market really isn't responding, because rates really aren't rising over the last 8 days. But they're not going down either. So just something to watch there. Oh, all right. I told you we'd look at IWM a little deeper real quick, and then I'll wrap it up. So I think I made the point. Levels to watch. What needs to happen today, tomorrow? If we do recover the trend lines, they would need a break again to make an objective short entry. Otherwise, we don't have that. We certainly don't have it right now, being above the trend lines. This is you don't see it. I see it. I have to move you over here. This is the Russell 2000 IWM ETF. What I do, this is something I came up with years ago, a way to give me real-time market breadth on any, the internals on any ETF or sector. Many of them, to the best of my knowledge, I don't publish that information on the Russell 2000, but I can do it quickly by sorting by gainers and losers. So here I did sorted by gainers. You can see right here, that's the percent gain for the day. There's your ticker. And what I do is scroll down. You can't see it in the video. I can't make this bigger right now, but it says 440. Well, let me just scroll down to the last green one. That's what I'm doing here. And I am almost there. Getting close. Okay, there it is. Last green symbol, even though it's flat. Just a couple of zeros, but this is going to change. Again, it's real time. So what this says, 690 out of 1587. So that's it. So it was earlier today. It was worse before the IWM ticked up, but you're still talking a nearly 2 to 5 decliner to advancer ratio, meaning you only have for every one stock up, you have about 2.5 that are down in the Russell 2000, and that's definitive proof right there. So there's that definitive proof too of the impact that one single stock SMCI is having, because the majority, by far, not even close, the majority of stocks and that's a big universe of stocks. It says 1,587 is what it says there, total on that. And the majority of those stocks are down only, a fraction or up. And so that speaks to negative breadth. Now, I always say one day doesn't make a trend, so maybe tomorrow. Again, you're seeing what you're seeing is the true impact of rates. The majority of Russell stocks are down because rates today, the 10-year bond, we're going to call it flat. Let's just say flat. Like I said, it's down a point. The futures on the 10-year, 0.13%. So I'm going to call that flat. And again, something to watch. And to just summarize the video, the beginning of the video where it said it's that mean reversion I'm seeing between the two. So I'm seeing rates, although in the last 8 days, not really moving up much anymore. They're not moving down either, and they're still in that yellow zone, which is kind of moderate danger. Orange is a little, obviously more danger, and then red is, like I told you, market will freak out if we happen to get there. So watch that. And another takeaway might be, hey, if, you want to buy these, the NASDAQ breaks out to new highs soon, and you want to buy that new high, you just keep an eye on it and know that it's probably not going to build on those gains unless bonds cooperate. Like I said, I can all but guarantee you if that divergence continues, the gains on the market are not only going to be limited to the upside, but you're talking a potential quick swoon down when the bigger that divergence happens between rising yields and the stock market going up. Usually the more violent the game of catch up is to the downside. Okay, that about covers it. So let me wrap it up here. We'll see how the day closes. I imagine it's going to be uneventful at best. We're either going to park, if the markets don't reverse before the close, we'll park a little bit above those trend lines. Not much. Like I said, we're getting close to the ceiling. Again, it's not a hard ceiling. It's just my, from experience, ceiling of about a 3% upside on the Qs in any given day, barring anything, crazy, like, at the end of a bear market, and then there's some government stimulus announced or something like that, and then you can get a 4 or 5% day. But so this is probably about it for today. So that's best case scenario, and then pick it up tomorrow, see what happens, or the possibility if we get a last minute dump. Oh, how do you know if that's coming? Okay, I'll tell you right now. If you want to fade so far it has this looks, smells, and feels like a trend day, meaning we'll continue up close positive in the close. But this is how I trade it. Yesterday, I predicted a rip into the close, caught it. And it wasn't random. No, we had fallen here. It was the same chart I gave you. QQQ at support with positive divergence on the 5-minute. Now we have QQQ. We have negative divergence on that same 5-minute chart. I've got a little short-term trend, a little wedge right here. And so that coupled with the futures, let me get to NQ. This is NQ5. Divergence is growing. We're at resistance right now, or a hair above it. About 1821 or so, give or take. In fact, if I look at the reaction high there, that's where the reaction high was. That's where that line should be set. So we're right there now. And I thought I had it marked up. Maybe it's on a different time. Oh, this is a 15-minute chart. That's why. But there's your similar wedge divergence on the 15. I've got a 5 over here for you somewhere. Here, I'll just toggle over to it. 1 week, 5-minute chart. There it is. NQ. So if you're a futures trader, you have a sub-minor trend line right here that might do the trick, and then this larger trend line, and then where to? If we get a hard dump into the close, depends on if and when we get a sell signal, of course. These are your nearby levels right there, there, and there. So let's see what happens. But you can see big, nice, clean, negative divergence right there. Building just like we had at yesterday's lows, positive divergence, and we took out the trend line, and that's what we got. So those are the levels to watch and trade if you see fit. This has been Randy Finney with Right Side of the Chart. Have a great day.